Good morning and welcome to this Wednesday, November 17th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we are now midweek. It's options expiration week. We had a nice session last night on Max Payne. Certainly that would point to perhaps, at least a little bit of selling here over the next couple of days to a week or so. Also, the signs that I was talking about a couple of days ago, the volatility index moving up with the S&P, we tend to see that play out if it's going to within a week to 10 days, or at least start to play out. So I would say by this point next week, as we head into the holidays, if we haven't seen the selling, probably not going to see it. But I do think that still there's a lot of risk in the air right now on Wall Street. I think you want to be a little careful in the short term. We could see a pullback at any time. Earnings, though, continue to come out strong. We're going to talk about that a little bit later. But, yesterday we had some really good reports coming out on some big names, Walmart, Home Depot, NetEase, some of those names. I'm going to take a look at those charts for you when we get to the three you must see at the end of the show. But just a lot, really going on. Always seems to be something. Retail sales much stronger than expected yesterday, so we saw a big jump there. We'll talk about that in just a little bit. But let's go ahead. I'm going to run you over to Earnings Beats for those of you who are new. And for those of you who are members, want to make sure everyone's aware that we are running our fall special right now that runs through Saturday, November 27th, midnight. So you got plenty of time, but we don't want you to forget, because this is not only our best deal of the year, but I think it's the best one we've ever offered. If you click on that link, it will take you to a page and actually show you that we are offering longer term memberships, which we have not done in the past. We've had members ask us before, can I get a special rate if I extend longer? Well, here's your chance. We're doing our normal 1 year, get 2 bonus months. That's our typical spring special and fall special that we run. But we've added a second year where you can get 6 bonus months. So you get 2 bonus months for the first year, then you get another 4 bonus months for the second year. So you got 6 bonus months. And then if you go out a third year, you get another 6 bonus months on top of that. Takes you up to a full year free if you go out 3 years. So you pay for 3, get 4. And if you have paid our monthly, or if you're on the monthly plan right now, that's normally $147 a month. You can see the rates really go down substantially by committing to an annual membership. Plus, we do have a few things that we offer annual members, things that take us a lot of time to prepare, that we offer annual members that we don't offer to our trial and monthly members. Just, Excel spreadsheets, things that we put a lot of work into, maybe a couple of our chart lists, like our sector relative strength and our industry group, especially our industry group relative strength chart list. Those are things that are really important to us, take some time. And once you have them in your stock charts account, you have them. So anyway, just want to make sure everyone is aware of the fall special. And then, of course, if you are completely new and you're not aware of our free Earnings Beats Digest newsletter, all it takes is a name and an email address. No credit cards, completely free. You can unsubscribe at any time. It's really just a way for us to give back a little bit to our investing community, people that have supported me over the years at stock charts, and those who've supported us at Earnings Beats here over the years. It helps you get a little better understanding as to how we look at the market. So 3 times a week, Mondays, Wednesdays, Fridays, out usually around 8:30 in the morning. Just a couple paragraphs in a chart, very simple read. I try to make it educational, but also, if you so desire, there are some trading opportunities many times in these stocks that I look at. One last thing here on the homepage I want to tell you about. We do have our draft tomorrow night. And when I say draft, we put 10 equal weighted stocks into our 4 stock portfolios. And you can see our performance here. We track it every day. Aaron tracks it. I track it. We make sure that the numbers are the same. And then we publish them here. You can see since inception, our numbers have been very, very strong relative to the S&P. And then this quarter, you can see just really big numbers. The aggressive portfolio is up almost 25% this quarter relative to the S&P 500, which is 6.7%. That type of performance makes big difference in portfolios. Now, everybody, we're not registered investment advisors, so everybody has to decide whether they want to use these portfolios in their, in their accounts that they trade or invest. That's completely up to each individual. We do this for educational purposes. We do it every quarter just to highlight leading stocks and leading industry groups. And we try to mix them up so that we have various industry groups covered in each of the portfolios. So I would not say that these portfolios are well diversified, because they do tend to focus a lot on growth stocks. So if growth stocks get hit, these are going to get hit. Think about, the IBD, the Nifty 50, or think about Kathy Wood's, her ARC funds. These are funds that have done very well when growth stocks are in favor, but when they're not in favor, they definitely underperform. That's the way you should view our portfolios. Income portfolio is a little bit different because we do focus on dividends. So you're going to probably see more value-oriented stocks in there, but value-oriented stocks haven't done as well as growth-oriented stocks. So you can see the performance since inception on the income is the only one that trails the S&P 500. So yeah, it's going to be a little bit less, or it's going to be more conservative, but it's probably not going to perform as well over time, especially in a secular bull market environment. Anyway, just want to point out, because we are going to be selecting the 10 equal weighted stocks that go into each of these 4 portfolios. That will happen tomorrow night, Thursday. I believe we pushed it back. I want to say it's 7, but maybe it's 5:30. I can't remember now. We have so many different webinars and times, but go on the website. You can check us out. I think under the About Us. Yeah, right there. You can check out our event calendar. And I guess I better check it out, make sure I know what time the event is as well. But we do have that coming up. I think that's a really educational event, in addition to just pointing out, some of the stocks that have had great results that Wall Street loves. And these are the types of stocks that we want to own. And the philosophy is, or the strategy is, that we hope that we're going to have 2 or 3 out of each of these 10 stocks in each portfolio that are going to carry the portfolio. I'm not saying all 10 are going to outperform, but the theory is that we're going to get a couple that'll do really well and will outperform, help us to outperform the market. And that's been the goal. And that's, so far, we've been pretty successful. But check that out. That's part of even a trial membership. If you're just a trial member, you're invited to that event, all of our webinars. So anyway, that is that. Let's go back over here. And I think I've covered everything. I do want to let all of our members know that in the last couple of days, we've recently updated several chart lists. So if you haven't already downloaded those into your Stock Charts account, if you are a Stock Charts Extra or Pro member, or haven't reviewed them, you can still you can view all of our stocks in all of our chart lists, even if you're not a Stock Charts member. But I would encourage the membership just to organize everything and to be able to download. My gosh, the time savings is phenomenal to take all of our research. But anyway, the chart lists that have been updated recently: strong earnings chart list, strong future earnings chart list, the strong AD chart list, the short squeeze chart list was just updated last night. And then also we have a Max Pain chart list for November from our Max Pain webinar. I just sent that to Aaron this morning, so we should have that up on the website later this morning if it's not already. So just check that out. Make sure you are up to speed on all of those chart lists. Still got the raised guidance chart list that I want to get out, but got the draft tomorrow night. I'm going to try to see if I can get it out, but it might be this weekend before I get the raised guidance. We'll see. All right, move on. Let's go to the action from Tuesday. Dow Jones Industrial Average up 55, S&P 500 up 18, NASDAQ 120. So clearly the strength was there. Mid caps up just a fraction, small caps up 1/4 percentage point. All the major indices, though, above the 20, which is above the 50, all trending higher. Yes, I think they're all subject to some near-term manipulation or maybe a little bit of selling here in the near term. We've got options expiring, got negative divergences brewing now. The S&P actually went up and tested this recent high and did so with that PPO lower. NASDAQ turning up, trying to move up as well with its PPO turning over, rolling over. Same goes for the mid cap. Small caps, not as much. Small caps probably look as good as any of them in terms of their bullish momentum right now. From a sector perspective, Couldn't have been much better yesterday, actually. Discretionary and technology leading, both over 1%. Discretionary up more than 1.5%. Part of that was retail. That big retail sales report came out yesterday, well above expectations. I think underscoring the strength of this economy and the strength of the consumer. Consumer spending drives our economy. So it's always good to see the retail sales reports coming in strong. Great to see discretionary stocks outperforming. I think this tells us the market's going higher in time. It's not always a straight line. And that's what, is so difficult about trading is, from a longer term perspective, honestly, for the past eight years, to me, just buy and hold. I mean, the pandemic, it was rough, but it's hard to catch a 100-year pandemic right before it happens. We don't have too much experience with those. But I would say the last 8 years, for the most part, you just buy and hold. And I still feel that way. I'm not seeing anything that suggests long-term we're in trouble. I see short-term issues. That's what I've been writing about these last couple of days. But that may or may not happen. I'll be honest. It's hard to time these short-term moves, back and forth. I want to clearly point out I'm bullish. So any short-term issues that I'm talking about are short-term. But discretionary, technology both did well. But you can see discretionary, that PPO's come down quite a bit. So if we do get up, break out to a new high, we've got to at least be aware of that. Technology, though, not bad. I mean, looks like PPO just going sideways here, ready to take off again. Healthcare up 0.4%, also had a strong day on Tuesday, trending above that 20-day now, which is above the 50. So everything looks pretty good there. Communication services pulled back. That was the worst performer yesterday. Continues to trade in this range. I believe the low is in, but I don't think we get confirmation on the next move to the upside until we can clear both the 50-day moving average and probably this 82.50 area. So we got a little bit of work to do there. Consumer staples also down at nearly 0.2%. But overall, consumer staples looks good. The problem is it just doesn't look good as discretionary. And actually, that's not a problem because as a bull, I want to see discretionary stocks outperforming staples, and they continue to. So I think overall, the action yesterday was pretty good. We just have to be aware we've got options expiring in 3 days. And a lot of these stocks, especially a stock like NVIDIA, that's going to report after the bell tonight, they've got their earnings coming up and they are deep. I mean, way deep, like waist deep in the money call premium, the net in the money call premium. So there's a lot of folks that have been betting on NVIDIA and they got a lot of money just sitting there, just waiting to hit their accounts on Friday. I mean, you can sell options anytime, but on Friday, they're either going to have to get out, they're going to have to exercise, do something. So between now and Friday, there is tremendous risk, in my opinion, in a stock like NVIDIA, because if all of a sudden you get a little sell-off and it could only be 3, 5, 7%, that's going to save market makers a fortune in option premium. So you got to be careful with these stocks, and especially with a big catalyst like earnings. I fully expect NVIDIA is going to have a big report, but is it already priced in? That's what we have to think about. All right, 10-year Treasury yield. Let's get a quick update. I know it was up just a little, 1.64. It's up about a half basis point, so it's up just a tad this morning. Economic news out. October housing starts 1,520,000 units. Market was expecting 1,587,000 units. So we came in a little below expectations there, but October building permits rose over the September levels. That was back below 1.6 million units. We had 1.65 million units actual, and the expectation was 1.63. Now, the thing you have to understand about building permits is that not all areas around the country require building permits. So when this number is strong, you pretty much know that the housing market is going to be strong, because this doesn't even include some of the areas around the country. The housing starts number is a little bit more kind of in the rearview mirror. Building permits is what we're expecting to see going forward. So I always like to see that building permit number strong. Looking at the yields, I mean, I just think we're range bound. I think this is a good, we had this huge run up back in February and March in yields, and of course, inflation was popping, and that scared. And that's when we had our worst quarter, by the way, in our portfolios. which ran from February 19th to May 19th. That quarter, the yields rising and the inflation scare really took a lot of the wind out of the sails of the growth stocks. And so we had a horrible quarter. I'll be honest. It was awful. But we've rebounded pretty nicely since then. We've kind of changed our strategy just a bit. But I still believe growth stocks are the way to go over the longer period. Short term, yes, they're going to be volatile. But you get a stock like NVIDIA that makes huge runs for you. You can afford to have, some weakness for a period of time. Tesla goes from 700 to 1250. It's okay when it pulls back 200 points. That's just the way growth stocks are. They're going to be more volatile, but in the end, in my opinion, in a secular bull market, they're going to be more valuable to own. So that's what we do. We recognize some of the quarters aren't going to be great. Think about the, portfolio managers though, who are trying to, and mostly unsuccessfully, trying to beat the S&P 500 every year. And here we are putting ourselves out on the line every quarter, trying to beat the S&P 500. If you haven't tried to do this sometime, pick 10 stocks and equal weight them and see how you do versus the S&P 500. It's not easy. I think our strategy works. I think it's been proven over time, but it's not something that's going to work every quarter. I wish I had that crystal ball where I knew every quarter what the market was going to do, but we don't. We can simply go with those leaders. And then over time, I would say hope for the best, but I'd be expecting the best. All right, moving on. Let's talk a little talking technically. First, retail. Retail, we had this huge jump back at the end of 2020, early 2021, and then we spent the last 10 months going sideways. Well, like the consumer discretionary group overall, retail finally made a breakout, and it is trending higher now. So I think the retail area of the market is an area definitely worth considering, because when it gets going, it can get going. And right now it's broken out. Now, could we pull back? Yeah, I think anything down to about 97.5 is possible. That's, 6% below where we are right now. So yeah, it's possible we go back down there, and certainly a 20-day test, that would just be a normal pullback. You can see in this move to the upside, there are opportunities when you get these pullbacks to the 20-day, and we might see one of those coming up. So that's something to keep in mind and to watch. Another thing I wanted to talk about is, if you've been watching the dollar's caught fire again. And it's one reason why I think you have to be very careful with energy and material stocks. I'm not saying you can't trade them. I'm not saying they won't go higher, because in a secular bull market, I think everything goes higher for the most part. But we're looking for relative strength. And when the dollar goes up, and I just want you to look at these last, 10, 11 years, when the dollar overall is moving to the upside, then we're going to have problems with energy and materials. So here's another 10-year chart. Here's your dollar moving up. Look at the relative strength of energy versus the S&P and materials versus the S&P. This is not saying they're not going up. It's saying that they're not outperforming the S&P 500. If we want to outperform the S&P 500 and the rising dollar is out there, it's going to be hard to do it if we're focusing our portfolios on energy and material stocks. Hey, I know energy's been hot for the last year, but let's look at it over a big picture. How does it look if you look at the last 10 years? Well, we've got the dollar rising again, and the rising dollar is what put all this pressure on energy and material stocks in the first place, in my opinion. And now we've got the dollar starting to rally again. So let's go back and look at that last chart I was showing you. What I follow in order to try to determine what's going on with the dollar index is how the US interest rates are doing, specifically the 10-year Treasury yield versus Germany's 10-year Treasury yield. Now, I've done work looking at correlation between different countries. Germany and the US, in my opinion, is the most positively correlated countries. So what happens in the US and what happens in Germany matters. You get a lot of talk about what's going on in China. Quite honestly, I just don't even pay attention to what's going on in China. Because if you look at the correlation between the US and China, it's all over the map. I can see no correlation. So if China market is having problems, in my opinion, that doesn't necessarily mean we're going to have problems. But if Germany's having problems, then I'm paying attention, because we tend to be much more positively correlated with Germany. Now, from a bond market perspective and the yields, this kind of makes sense. Going back to my economics 101 days back in college, it used to be just whatever was going on in the US. We were more of just a domestic economy, not nearly as global as we are now. And I remember back in economics class just talking about, when the economy strengthens, interest rates go up, and when interest rates go up, the dollar strengthens, and it all kind of flows together. Well, being in a global environment, you can have your economy strengthening, but if your economy is strengthening less than other countries, your currency is going to weaken. It's not going to strengthen. So what I like to do is follow what the yields are doing in the US versus Germany so that I can get a better sense of how our economy is performing relative to another economy that is closely correlated to the US. And so when I see this yield going up and I see the dollar going down, what we typically see is this inverse correlation down here at the bottom. And when we get the inverse correlation, the history tells us the dollar usually is the one that's out of whack and has to recover. And so that's what's happening right now. We had the US Treasury yields going up. It was telling me economy stronger than Germany, dollars should be going up. Instead, during the pandemic, just like everything else in the market, everything's crazy and whacked out because, of what we've been through. The economy and all the different things that go into the economy. Never seen anything like this pandemic since the 1900s, and a lot's changed since the early 1900s. Anyhow, but the Treasury yields, we're starting to see the US Treasury yield rising. Each one of these little quadrants right here are quarters. So the US dollar right now is probably at about a 9 or 10 month high. Actually, it's more than that. Yeah, the dollar is at more than the year high. The yields in the US versus Germany up to about a 9 month high right now. So, but this whole move right here was ignored by the dollar. See how the dollar kept going down? And so I think the dollar is playing catch up right now. And you can see we're moving now back toward positive correlation, which is more normal in the Treasury yield in the US versus Germany. So I just wanted to explain that and go through that because, and I like to do that every once in a while, because the dollar has a big impact on whether or not I want to be interested in energy and materials. And by the way, if you go back and look at the dollar, let's go back to the other chart, the dollar chart. Look at when the dollar was going down, and don't look at the dollar going up or down as being equal to a secular bull market or secular bear market. We can have a secular bull market with a rising dollar. We can have a secular bull market with a falling dollar. It doesn't really matter. I mean, we can have bull markets. Actually, the dollar was coming down 2002 to 2007. And remember, that was a cyclical bull market within the secular bear market. But we had a weak dollar while the stocks were going up. And I remember a lot of the media folks were talking about, oh, we want the dollar to drop because that's good for the stock market. All they're doing is looking at two things that really are not generally that correlated, but because they've been correlated, all of a sudden it's a new fact. The dollar can go anyway. The thing that the dollar impacts is energy and materials. So when you see the dollar moving down like this, look at energy and materials outperforming. When we get the dollar moving up, energy and materials are underperforming. I call energy and materials my neutral sectors. We've got aggressive sectors, we've got defensive sectors, and then these two, in my opinion, are just neutral. It doesn't really matter whether the stock market's being aggressive or defensive. What matters is what's the dollar doing. And so the dollar right now is turning back up again. I think we've got to be really careful with energy and materials. I might be wrong, but this is why I believe what I believe. So you can take this information, ignore it, you can disagree with it, whatever it is, but I follow the charts. I don't follow anybody talking in the media. I like to follow what the charts are telling me. I like to do intermarket analysis. I like to research. I like to find what makes the stock market tick. And it's not CNBC special hour or whatever. I mean, yeah, they have some good guests on there from time to time. I'll give them that. But as far as educating the public, I'm going to give them a big zero. I don't think that's really what their interest is. So watch the dollar. If the dollar continues to move up, and we can pull up the dollar and just show you here quickly on a daily chart. I mean, look at what's going on here. That's important. I don't buy and sell currencies, so it's not important to me from a currency standpoint, but it is important to me from a trading perspective. That is just, to me, telling me, beating me over the head not to buy energy and material stocks. Now, if I did, or if you buy those stocks, what I would simply do is just keep my stops in play. Remember these charts I'm showing you. Doesn't mean they won't go higher, but if you have energy and you got energy stocks and you go up 8% this year, and the S&P 500 goes up 22%, how good are you going to feel? I mean, that's what we've been dealing with really for the last decade. All right, let's keep moving. So I wanted to show you also the home building chart, because we did get those housing starts, building permits out. You can see we're trending higher here. So I think housing looks better. And this, if you haven't seen it before, might surprise you. Let's go to the seasonality chart for home building stocks. And let's draw this thing back 20 years. November, look at the average gain during the month of November, December, and January. These are the 3 best months of the year we're in right now for home building stocks. Probably wouldn't have thought that. November, December, January, winter. Why would you do that? Well, I think what happens is it's anticipating the spring. Remember, the stock market's always looking ahead. So I think a lot of times you're getting these home building stocks moving before the spring season. Interest rates are still historically low. Even if they go up some, housing is still extremely affordable based on the very, very low interest rates. Anyway, thought that was interesting. Always want to pull that up from time to time. All right, we only have a few more minutes. I'm going to move into earnings. I want to just talk a little bit about companies that came out this morning with earnings. Lowe's, my gosh, and I'll bring up the real time so you can see some of these reactions. Lowe's up another 3%, had a huge day yesterday because of Home Depot, now tacking on even more. They crushed earnings estimates, 273 versus 233. If you're bearish to the stock market and you're still clinging to high PE ratios, I hope you're paying attention to what all these earnings are doing, because we're going through yet another earnings season with really big beats across most companies, not all companies, but most companies. Target, another big report, $3.03 versus $2.87. Stock, though, down 5%. Now, Target, and I think Target was the one that had been losing relative strength recently. So let me pull that chart up. So here we're moving up, but we haven't been able to break back out. That relative high was set all the way back in August. And during this period of consolidation, we kind of went sideways. I want to see Target break out again on a relative basis. We broke out on an absolute basis, but not on a relative basis yet. Today's not going to help with its earnings, but they did beat. So I would be watching like the 20-day, can we close above that 20-day later today? That would be an important development for me with Target. Let's see. One stock getting hit hard after hours last night from reporting earnings was StoneCo, and it is down 16% this morning to 26. Look at the way this stock's been performing, though. I'm going to get into the 3 you must see in 1 second, but let's look at this last chart here. If we pull up a relative chart, this is in software. If you've been following the market at all, you know software has been on fire. Well, here's a software stock that's been going down, down, down. Relative strength is absolutely horrible. Wall Street won't touch this stock. And now today it's down 16% with its earnings. They were expected to earn 12 cents. You know what they posted? A loss of 78 cents. This is why I follow relative strength. Look at all the volume. This stock has been getting torched by Wall Street. And now we see why. All right, 3 you must see. These are going to be, I'm going to give you a bonus if I can get through these really quickly. I'll give you 4. But these are all companies that reported yesterday, in the morning yesterday. Walmart had a big report. All of these beat expectations. So I'm not going to give you the numbers, but they beat. I'd look for Walmart maybe to turn within this gap support zone. That's what I'm looking for. HD, Home Depot, crushed it, knocked it out of the park. AD line strong, broke out again. Home Depot looks great, as does Lowe's. NetEase gapped up, pulled back, but volume was good. I think the AD line's been pretty strong. This stock, I think, has been accumulated as it was going down. You can see the AD line rising. I think the worst is behind it. I see it going higher. TDG, TransDigm. This one actually was up after earnings, pulled back, had a big earnings report, and on a relative basis to aerospace stocks was at about a 9-month high a week ago. So this is a stock that's doing well versus its peers. Unfortunately, aerospace remains in the dumps. But if the group ever starts to roll, this is a stock to watch. I think a breakout above 690 would be very bullish for TDG. All right, let's move to the dashboard, take a quick look at what's going on. All right, we got the Dow Jones down 46, S&P down 3, NASDAQ down 4. Not really anything at this point. I would just be careful. Again, I've been stressing that these last couple of days. Long term, I'm bullish the market. Short term, got to be a little careful here, I think, with options expiring. Almost always we want to be careful anyway with options expiration week. We know the history of not only this week, but then the week that follows option expiration. It's typically not good. November and December, a little different. They actually are better than the other months. So history is on the side of the bulls. Long-term is on the side of the bulls. It's just this short term. And I'm going to say like the next 3 to 5 days that I think we're either going to get that pullback or we're going to take off again into year end. And we're going to find out which. Anyway, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. All you have to do is go in here Thursday at 9 a.m. Eastern, click on Stock Charts TV. You'll get my next Trading Places Live. Everybody have a great day. Happy trading.